Rock and roll. We have another Build Your Legacy Masterclass with the man, the myth, legend, the mad scientist of multifamily. But for today's purpose, we're going to be calling you the mad scientist of build to rent, because that's what we want to talk about, that and capital raising. I'm sure that's
Badass of build to rent.
Yeah,
We say
there
that
you
on
go. So
yeah.
we got the co-host, my best friend in business, the other man, myth, and legend, Andy McMullen of Legacy Acquisitions. We're not going to spend too much time introducing each other. I think a lot of us are familiar with the build to rent space, and the listeners of the Capital Raiser show, this is going to be broadcasted to all those guys. We got 2.5 million downloads on there. So welcome, man. But there probably is a couple of people in our audience that have never heard of you, which sounds crazy to me, Neal. But would you mind giving us a 1-minute introduction of who you are and what you do?
I am a technologist, a computer science graduate, a data scientist by profession. I've had a successful tech career running a company for 14 years that we exited in 2013. For 10 years before that exit, I was investing in real estate, building custom campuses for my company. We built 6 of them, and also investing in single family real estate. Since that exit in 2013, I've been investing in real estate, initially just with a bunch of friends, and then with 950 other investors. The portfolio is $1 billion. 70% of the portfolio is new construction, 30% of it is value add. And we sort of like that mix, but though right now, not a bad time to start picking up value adds again. Build to rent is something that I'm most passionate about, even though it's not the largest portion of my new construction portfolio. It's something that really gets my attention because I see a big problem that I can help solve. I'm very mission driven. So hopefully we get a chance today to talk about build to rent after we talk a little bit about the market.
Yeah, cool. So we're going to have some big players in the house. Welcome Vinny Chopra and Dinky Lumba and everyone else that's joining us, and the other syndicators that are going to be asking some questions in about, I don't know, we might open it up a little bit early. Like I was planning on going about 40 minutes, depending on how many people show up. We might open it up for questions because I know we got some hard hitters in the room. But why don't we start with this? Like, I've seen some of your webinars. They're very powerful. You speak with conviction. I love that. One day I want to raise for you. I saw you on Hunter Thompson's event recently, and you were like very smiley and giddy because he was creating capital raisers that were going to work with you. And I'm going to be launching a capital raising mentorship program with Vinky, who's in the house as well. And maybe my first question should be this, is like, if we're going to do this, or I should say, as we do this, like, how can we create some capital raisers that help you raise capital for BTR? What do we need to tell them? And what do we need to tell the human beings out there that I love that are interested in getting into investing? Like, why should they invest in BTR and not the other asset classes?
I think that you would need to do exactly what you do for multifamily, right? So if you think about multifamily value add, every equity raiser that's been doing it for a while knows the spiel. They know what's the good things about multifamily, the depreciation, everyone needs a place to live. We're not building enough assets. We're not building enough single family. We're not building enough apartments. You guys have the process, right? Let's call it the 10 highlight points. Pretty much everyone that raises money for multifamily hits it. And so you have to really learn what those are for build to rent. I'll give you kind of the short version of those. And as Ruben mentioned, there's presentations that I've done that are just about BTR. So there's a lot more content there. But essentially what has happened is this. So in 2009, 2010, when there were millions and millions of homes available for sale, Wall Street got into the act, and a company called Blackstone, which created a subsidiary, started to buy single family homes, and they ended up buying 80,000 of them. And then through another company, they ended up buying 17,000 of them. So this was the institutional grade SFR, or single family rental business. The business was extraordinarily successful because whatever they bought over 5 years more than doubled in value. So with multifamily, we never get doubling in value, or almost never get doubling in value. Most of the time, the value increase is about 50%, 60%, and that doubles our investors' money because we use leverage. So imagine if you bought 80,000 single-family homes in 2010, and their value in 2015 was double or 2x. So your investors are probably tripled your money. So Blackstone and there were a bunch of others, Blackstone being the biggest, basically went through this process. By 2015, they couldn't buy single family homes at prices that made sense for rents. So they couldn't get any cash flow at all by 2015 because prices have gone back up. So they looked around and they said, what can we do to increase our inventory? That people are selling these single family homes at too high of a price. And so they noticed that there was this guy, his name was Christopher Todd, and this guy was in Phoenix. And they noticed that he was building something known as a horizontal multifamily. No one else had ever built anything like it. And so horizontal multifamily, which now is considered part of BTR, it's not the only part of BTR, but it's considered part of it, is basically imagine a building, and that building either has 1 unit or 2 units, and it's 1 floor. So it's a single floor. There's no garage, but there's a little backyard, right? And the front yard is kind of a walking path, and you can see all the other homes, right? So your garage is somewhere on the property, which it's just an open parking space, right? But now you live in a home, and some of the homes are by themselves and are probably 2 or 3 bedroom, and some of the homes are two homes attached. So you're sharing one wall, but you still got your own entrance, right? So you got your own main door. So think of it as like a duplex model or a single family model, but no garages. The garages are basically, you're parking your car somewhere. And then lots and lots of amenities, gym, pool, clubhouse, all of that stuff. So he built this first one, and it was like 150 units. It was a huge success because people that lived there thought of it as their home. No one that I know of, no one that I know of has an apartment that people think of as their home. That's the difference with BTR and apartments. People are in apartments because they have no choice. People who start living in built to rent within a year or two, a lot of them, not all of them, start thinking, this is it. This is what I want to be in life. This is my home, and I want to live here as long as I possibly can. That mindset change does not ever happen with apartments. We've never seen it. I own lots of apartment projects, and I've never seen that happen. And so the turnover in apartments is around 51, 52% a year. So you lose half of your people every year and you refill it. The turnover in BTR properties is around 35% a year, and some BTR properties are even lower. So they live there longer, even though you're raising their rents at about the same speed as apartment or slightly higher. So that was happening in 2015, 16. And so now Blackstone had a new thing to buy. They had these horizontal communities. Then some other builders started developing townhome communities. So these were townhomes, right? So you've got usually with 1-car garage, though in some states like the Midwest, they had 2-car garages. And then some people started developing single family homes, but put 100 of them together, put a gate around it, put a pool in the middle, and call it a single family built to rent. Now, they've gone out of fashion in the last year because the cost has become too prohibitive. So now most of the single family BTR is only happening in the Midwest where land is cheap and construction is cheap. The rest of the United States is mostly focusing on either horizontal multifamily. Remember that model I told you about what Christopher Todd is doing, no garages, or townhomes with 1-car garage. So built to rent is a replacement, not for apartments, but it's a replacement for the single family home. Americans, even before COVID, had mostly lost the ability to buy single family homes because of increases in prices, right? And so BTR, whether it's horizontal multifamily, townhomes, or single family built to rent, so there you're living in a single family home, but you're in a community, but every home is rented. All 3 of these kinds of built to rent are really designed as a replacement for people who would have bought a single family home or would have rented a single family home, but both of those are too expensive. Now, 2020 happens and the need for BTR explodes. And why does it happen, right? So here's the answer. In 2020, right before COVID, you had a certain level of income that you needed, right, to buy like a really, really crappy old starter home, right? Like you were thinking maybe 1 bedroom or 2 bedroom and the home is like 80 years old, right? You could buy that for a certain income. Between the start of COVID and today, the last 3 years, that amount that you needed, the income that you needed has increased by 88%. 88% in 3 years, right? So imagine people getting 25% annual salaries for 3 straight years and still not being able to afford it because 25, 25, 25 still doesn't get you to 88. So you basically needed 30% salary increases every year for the last 3 years, and that simply doesn't happen. So what happens is that there are about 8 to 18 million families, depending upon whose data I pick, that are simply priced out of ever being able to buy that starter home, that 100-year-old old starter home. They can't buy it. And Rents have gone up insanely. Like in 2021, rents increased by 16% in a single year. For single family, by the way, they even increased a little more like 17%, right? So rents have also gone up for single family rentals. They can't afford those anymore. And so now there's this middle America. I call it middle America. These are people that make between $60,000 and $85,000 a year. Okay. And this group doesn't want to live in apartments. And for good reason. This is a slightly older audience than the apartment audience. And they usually have 2 kids or 3 kids and 2 dogs. And it's kind of hard to fit 3 kids and 2 dogs and two parents into an apartment. So they don't want to live there. And previously, their only option was buy a single family, can't do that, can't afford it. Rent a single family, can't do that, can't afford it. And apartments. But now something exists in the middle, and that's called build to rent. Build to rent is basically 10% of new construction apartment activity. Let's call it 10 to 15%. So in the United States, in a normal year, we build 350,000 apartments. These are so 300,000, 350 is normal. Right now, we've got overbuilding, so 400,000 is coming online this year. But 300, 350 is pretty common number. So imagine 15% of that. So you're talking about, 45,000 units, right? Currently, there are 45,000, 44,000 built to rent units in construction. So think of built to rent as the top of the new construction apartment market, which is taking 15% of that new construction apartment market away, and those are going to become built to rent. Why not 20%? Why not 30? Why not 40? Well, the answer is price. Typically, when you're renting a townhome or renting a single family BTR, you're going to pay more than an apartment. Well, only a certain percentage of those apartment dwellers, new construction apartment dwellers, can afford to pay that increased amount. So it's the top of the new construction apartment market. I expect that with 50,000 units being built a year, we will roughly have, in about 20 years, we'll have between 1 and 2 million BTR units. The demand is about 7 million. So I don't expect that we will even reach the demand in 20 years. And that's why I'm involved in it.
Love it. Love it. Love it. Love it. No, this is so exciting. I think with the new model, with all these people working from homes and everything and remote, and having that ownership is so important. Having that ownership. And even though it's renting, but it feels like you are owning that space,
Yeah, I mean, it's these things, they don't feel like an apartment, right? I'm going to show you an example and
Mm.
share it on the screen. This is obviously a chat, so I don't want to get into PowerPoint, but it would
Yeah.
be useful for you to see what these communities look like, and you'll instantly say, you know what, this doesn't feel like an apartment. So here's one of my communities. This is a built to rent community. It's 100% occupied. And you can
Mm.
see it's basically fourplex townhomes. They each have a 1-car garage. People
Yeah.
are also parked in the front, and then I've got parking in the back. You'll see it in a moment. You'll see the parking in the back in the moment. So you really have 3 spaces for your car. One
Mhm.
inside the garage, one in the driveway, and one on the side. So this is a 6-plex, this is a 4-plex. So there's, usually when I build townhomes, some are 6-plexes, some are 4-plexes. And I don't amenitize them. There's no gym. Because if you buy an old single family home, do you get a gym with it? Do you
No.
get a pool with it? So I don't do pools. I don't do gyms. I'm not interested in those. I'm not interested in increasing the cost. I'm replacing the single family product. So I don't do anything more than that. But the inside is very nice. I mean, these are very nice homes. On the inside, you get 9-foot ceilings, you get, nice countertops, you get, some granite countertops or quartz countertops. It's not huge, right? These are about 1,300 square feet. Let me see if I can find more pictures for you. So, here's a bathroom, looks nice. These are the appliances, sort of a black steel mix. Here we go. So you can see, again, not terribly complicated. In the end, it's apartment plus. If you're building a Class B apartment, you'd probably put all of the same stuff in there.
Neil, let me ask you. So, a lot of the projects that we've been building, we'll have very simple, very simple finishes. As you mentioned, we did get kind of a bump really in a pool of renter, which we didn't expect, which was one, the young families, which of course we should expect, but people staying in kind of their home a little bit longer and maybe not wanting to go to a senior living, right? So we've got some empty nesters as well.
That's
But
right.
one thing that we're bumping up against, I think that you hit upon, and I'd love for you to elaborate a little bit, is the cost to build now, especially in light of what we're seeing with insurance. Right now, we're not competing with the same resources that we were before with built to sellers, right? Because of the interest rate. So we've got maybe our pick of the lid on the labor. But I am curious to hear like how you've adjusted your plan as costs have started to evolve a little bit.
Short answer is today, nothing pencils out in most metros in the United States. I don't have a good answer for you. I just have an honest one. Okay. So I don't find projects penciling out in just about any of the boom town metros. And you can go from the West Coast to the East Coast. They're not going to boom. Phoenix is, of course, a very dangerous market for BTR. So there's only one oversaturated market for BTR in the country, according to all the analysts, and it's Phoenix, because that's where BTR started. It's the home, birthplace of BTR. And so there have been so many BTR, people doing stuff there that it's considered highly saturated. So other than that, if you look at all the boom towns, none of them do the numbers actually work. I mean, you can make any number work in Excel by just moving numbers, but I don't believe that they actually work because of construction costs. So I have taken the approach of only identifying properties with low property taxes and, if possible, low insurance. You don't always get both of these. But if I had to get one, I would always take low property taxes over low insurance, right? Because insurance is a much bigger hit to net operating income than property taxes are a much bigger hit to income than insurance is. So if I could take one out of the two, I would always take property taxes. There are some markets that are low property tax and low insurance. And then the mandatory requirement, and you hit the nail on the head, Andy, the mandatory requirement is low cost of construction. So in boomtown metros, your vertical cost of construction is going to be 150, 160, 180, per square foot. None of those numbers work, right? So you're looking for markets where vertical cost of construction is 120, 130, 135.
I want
right?
to rattle off some of the things that I've heard you say on your webinars, and some other built to rent syndicators have said. Residents stay on average 40 months versus 18 months, and they pay the most and default the least of any segment, and rents are rising fast. It's recession resistant. BTR will outperform other commercial real estate sectors by a mile in some cases, depending on your market. A shortage of housing, 4.4 million homes are needed, depending on what data you're looking for. There's massive demand from institutional buyers, which you have not hit on yet, Neal. I'd be very curious about hearing about how much demand there actually is and how that's driving the cap rates down, if that's still going on according to you. There's low maintenance on these brand new homes, no maintenance for at least 10 years, lucrative returns for all involved. They're detached horizontal multifamily, like you said, where all the units are in one place. It's not scattered side. One property manager, one leasing agent. The residents get a backyard, privacy fence, in some cases doggy door, driveway, in some cases amenities. And we don't have to compete. This is what I kind of like, and this is something that I've kind of hit on quite a bit, is we don't have to compete with numerous syndicators to bid on the same property like multifamily syndicators do. And it's easy to follow other developers like DR Horton into their markets and mimic the deals that they do, that they've made a bunch of money on, depending on where you go. Obviously, built to rent is very different in Portland than it is in New York versus Atlanta versus Dallas versus Phoenix. We like the Southwest, where land is super cheap and it's in pro-growth mode. Now, the other thing is government. So the cities will a lot of times help us get through entitlements if we're going to the right place, and it attracts higher income tenants. Anything that I just mentioned here that you want to elaborate on or you want to hit on further?
Why do we need him?
Couple of things, right? I mean, the list was incredible, by the way. So anyone that actually, remember the first question you guys asked me, right? What do people need to know to be able to tell the BTR story to their customers? I mean, that was an incredible list right there, and this is being recorded. So go back to what Ruben said. That list was fantastic. The one piece is institutionals, right? So institutionals are very interested, but they're also very patient capital. There's no indication that currently BTR is getting lower cap rates than brand new apartments. Okay. Now, a year and a half ago, it was getting lower cap rates, but as the interest rates climbed, BTR interest has remained very high, but the institutional capital still wants to pay what they're paying for Class A apartments. They don't want to pay more. Now, that story might change again as interest rates go down over the next 2 or 3 years. I do expect it to change. But for the moment, the ability to underwrite BTR at cap rates lower than new construction apartments, that ability has disappeared. You got to underwrite them the same way, right? So that's one of the things that I want to point out, to you. And despite everything that Ruben said, I agree with. But the caveat is this: construction cost, property taxes, and cost of insurance are the three big gorillas, which in my mind, and this is a personal opinion, have basically made BTR projects for the moment, today, right now, unviable in at least 95% of the United States. I believe that 95% is going to keep dropping as the Fed keeps dropping rates. And maybe 2 years from now, you can build them in half the United States, or maybe even more of the United States. But what is happening is that the market is so getting crowded out by these very high construction cost, very high property taxes, very high insurance, and then very high interest rates. The combination of this makes it very difficult to do BTR, just like it makes value add multifamily difficult. I mean,
having trouble,
anyone who's honest is going to say that value add multifamily currently is close to being insolvent, right? I see all these numbers. And while I'm extremely bullish on value add multifamily, I'm patiently waiting for cap rates to further increase. They've increased a great deal. So they've gone from 3.5 to 5. And I'm waiting for them to go to 5.5. The challenges that value add multifamily has that other asset classes also have, BTR has them too. You can't walk away. It's not a magic bullet. I don't find it to be a magic bullet at all. So what we are doing is we're using data analysis to figure out those markets in the United States that have very high demand, very low construction cost, very low property cost, tax cost, and if possible, low insurance. You don't always get all of them. So the market in the I've only found one market in the United States that checks all of those boxes off, and that's a small market called Idaho Falls. So Idaho Falls has extremely low cost of insurance, extremely low cost of construction, and extremely low property taxes. So the trifecta. Now, does it have extremely low interest rates? No, there's no place in the United States that has extremely low interest rates, but you do get local lenders there that will still give you 70% loan to cost. 70% LTC allows you to build with a lower amount of equity than, let's say, building in Austin today. You would only get 60% LTC, so you would need a lot more equity.
Underwriting this versus multifamily, I get that question a lot. Like, how do you underwrite this? Like, how do you figure it out? Like, can you explain a little bit of how you underwrite this in comparison to a multifamily?
The short answer is it's underwritten just like new construction apartments. I think underwriting new construction is a completely different beast from underwriting value add. So you either need to go take a class, and here's the problem, right? There's a million guys teaching value add multifamily underwriting, a million people, right? And I think they all do a pretty decent job, right? So there's a lot of help there. But underwriting new construction, there aren't any classes available. There are some guys that basically do underwriting for a living or run underwriting, services. And those guys from time to time provide classes where you can go in and take these classes. I don't have an easy answer to your question, Ruben, except to say BTR would not be underwritten any different from new construction multifamily. But new construction multifamily, if you've ever seen a pro forma, it's very different from a value add pro forma. It's not impossible. It's just more complex.
And for those listening, we've got a model that we've created, and if you're interested in taking a look at it, reach out to us. I got a question about this because we've had conversations at various conferences, and I remember speaking with you, I think it was about a year ago, when we talked about maybe very bearish on kind of what's happening because there's some uncertainty with the interest rates, definitely some uncertainty with multifamily projects, right? I think you were putting on the brakes on any new, but I've recently heard you become much more bullish about just the economy in general. And you, like me, remember what it was like in 2008. If we were to listen to everybody, the market didn't come back till 11 or 12, but there were a lot of us making some money in 2009 because, as you just mentioned, Blackstone was one of them, where they basically bought up all these scattered sites, right, and figured out how to buy 50 cents, 40 cents on the dollar.
Well, so Neal was buying one property a month in 2008, right, because Nobody would believe me. And my family actually prevented me from going to parties because they thought that I would infect other, people in the family and they would lose all of their money. So for 2008 and 2009, I was not allowed to attend family events. And they all regret it now, and they're honest enough to say it. But, in that time frame when I was banned, I was like, well, if I'm not going to go to parties, I'm going to go to open houses, and I ended up buying, more than a dozen of them. So bottom line is that, yes, Andy, the honest answer is this. For build to rent right now, I'll just be very blunt and say this, okay? I don't think this is a great time to build to rent or any kind of new construction project anywhere in the United States, because you've got very, very high construction costs and very, very high interest rates. So what should I be doing? Well, this is an incredible time to be doing what is known as land banking or land squatting. And my favorite is land banking or land squatting for BTR, right? But you could simply apply every comment I'm making to new construction apartments. You could apply that to hotels. You could apply it to anything that requires new construction. Land banking and land squatting are two different strategies. Land banking is common, land squatting is advanced. Land banking is a process of basically, putting land in contract at lower prices and offering low balls. Let me explain. Today, if you wanted to buy a multifamily property, and you'd probably get a 20% discount from peak, right? But nowhere in the United States are you going to be able to get a property that's 30% discount from peak, right? So then the range of discounts is going to be pretty narrow. You might get a 15% discount, you might get 20, and maybe if you're lucky, you might get 25. So that range is pretty narrow, 15 to 25% discount from peak, which was in late 2021, early 2022, 3.5 cap. Land is not like that, and most people do not understand this. When interest rates go up to this level or close to this level, land becomes completely illiquid. Land's worthless. It has no cash flow. It still has property taxes, so it becomes worthless. So when these conditions happen, land becomes discounted, very highly discounted. And here's the cool thing: the discount percentage varies a lot. So you can get 20 to 55% off. Well, that's just been my recent experience. 20 to 55% off on land during this time. And look at that range, right? I said for multifamily 15 to 25. Here I'm saying it's 20% off to 55% off. So land becomes extremely cheap and the range is very wide. So it makes a lot of sense to do low balls. Whereas low balls will get you a band with multifamily, brokers. If you basically lowballed it and said, I want this piece of land for 40% or 50, or this property for 40 or 50%, they won't work with you again. In land brokers are not like that. They will take any offer, no matter how low, to the seller. Okay, so it's perfectly okay to throw ridiculous lowballs out there. I currently am bidding 50 to 60% below the prices of 18 months ago. And that is land banking. And you want to get as many months as you can before you go hard on money. I'm currently underwriting. If it's a zoned piece of land, I take 4 months before I have to, go hard on money. If it's non-zoned, then I take 6, right? And because I'm making such a humongously large number of offers every month, every week, I don't care that I have a win-loss ratio of 100 to 1 or 50 to 1. Because what I'm doing is not land banking, it's the advanced strategy of land squatting. Land squatting is where you take the 4 to 6 months for your money to go hard, but then you put a clause in there that says, I now have another 12 months after that. And during those 12 months, if the city does not approve my zoning, I get my money back. Now, as you can imagine, land squatting is much more difficult than land banking, because now the seller says, oh, that means you could basically not buy this property for up to a year and a half. The answer is yes. The truth is, it's probably going to take a lot less time. That's what you're doing to convince the seller. You're saying, look, normally it takes us about 3 or 4 months to figure out the zoning thing. It takes us about 7 or 8 months to figure out the city, and then we go ahead and buy it because we want to get started with our syndication and get paid. So you convince them that way. Most of them are not, they don't fall for it. They're like, no. I don't want more than 6 months total timeline. And I go, okay, well, in that case, goodbye. I can't say that 18 months ago because people would laugh at me. But today, every 20th or 30th buyer says, okay, come back. Just give me a little bit more hard money, do it. So I just signed an LOI for a piece of land. On the purchase and sale agreement, I had to put down $15,000. And after 6 months, I'll put down another 15,000. So that's 30,000 hard. And then I have 12 months after that to close. So for 18 months, I'm using $30,000 to squat on 10 acres of land, which is sufficient to build 130 units. This strategy is called land squatting. And it gets me beyond all of the interest rate issues, all of the construction cost issues, all of the LTV, LTC issues. That's what I'm busy doing, squatting on land all across the United States.
That's amazing. Hey, Vinny, do you have to jump?
Yeah, I have to go. I just wanted to say thanks so much. I think the build to rent I've also heard. I know a couple of my other good friends are also building in Florida, townhouses and all these projects have stopped. The where I'm finding a lot of opportunities in the hotels, as some of you might know, we're building from scratch. We are buying hotels. Today we bought a hotel for 10 million eight. To build it, it's going to be $18 million. So we got the loan, 70/30 loan. We got it, 6.5% loan. So, there are opportunities out there, right? Brand new. Holiday Inn Express. The other one is the assisted living. I was going to say, Neil, finding the land to build assisted living, because the numbers are amazing in assisted living. It's built to rent on a hyper, because you're able to charge $4,000 to $10,000. The one in Scottsdale, I'm converting a Comfort Suites hotel to senior assisted living. The next door is charging $10,000 a month. 10,000, and we are taking our assumption at only 6,500. Still, we are making huge returns. So those are the two I was going to mention. Yeah.
Amazing.
Great stuff, Vinny. I always love hearing about what you're doing. Next time we'll have you talk about. You're smiling whether it's a down market or up market, so I'm not sure it's convincing all the time, but I would like to have you on talking just about your outlook.
We'll bring Vinny back for sure.
Sure. No, I'm in the blue ocean. I say that. Red Ocean is very competitive, multifamily. I've sold most everything. I've got only 5 assets left, which are very big ones now, 50 million, 40 million, all that. But, the retrading is going on right now. I lost 4.5 million in just few weeks, just because the insurance cost has gone through the roof. So
Wow.
all these, other places, I just feel like it's time to pivot a little bit. And you can all pivot along with, me and others and everything. I know Neal is amazing. The key thing is it's the blue ocean, the assisted living, RAL, also the commercial, I should say. I say instead of RAL, it's MAL, multifamily assisted living is the new term in my book. The big thing is it's a huge runway for everybody for next 30 years. Yeah.
That's a nice hat. I love Budapest, Vinny.
Thank you. And also, again, if I may say a little bit, everybody listening, hospitality has taken a big it's back to even bigger than pre-pandemic, because everything went down. Nobody came out of their homes for so many, because they didn't want to get killed and spread the disease and all that, COVID. But now it's the ADRs, average daily rates are at its peak, double, triple average daily rates in the hospitality, and occupancy has gone up like crazy in the tourist attractive places, tourism. So that's where we are very, very excited to build and also buy, Yeah.
Awesome, Vinny. Neal, tell us, so did you complete your process on the capital raise for your New Brunswick project? How did you sell that one?
The project is a 3-phase project. So we've completed the raise for the first phase, which was about 18 months ago, and the second phase, which we were working on now. So there's a third phase that needs to be done, but we're not in a hurry on that, because that money is really not needed by the bank until next year. New Braunfels is a 128 unit townhome community, all the way from 2 bedrooms to 3 bedrooms and 4 bedroom units.
Andy,
I was
what
going to
question you
say,
got?
this is really important because I think there's a lot of the audience that's capital raisers. And I thought you had just an incredible description of why we're dropping the ball every time that we talk to an investor, about that investor that's kind of proud of itself for investing in a money market, or kind of proud of itself for investing in the stock market. What would you tell the capital raisers that are here about the conversation they need to be having with their investors about the state that we're in with inflation and all the rest?
I think the best thing to attack is that money market. So today, most people can make 5% on money markets. So you hear from investors, I was making 0% before, now I can make 5%. And so this is the right thing for me to do. That is a very nonsensical idea. This is a ridiculous concept and idea. When you had inflation at 1.5% in the United States, you were making 0% in the bank. So you were making minus 1.5% compared to inflation, right? Today, inflation is at 6.5%, and you're making 5% in the bank. So you're making 1.5% minus. Nothing has changed. Absolutely nothing has changed. You're still making 1.5% less because of inflation. Inflation is still reducing the value of your assets by the same 1.5%, right? But somehow magically you think that you're better off. This is not a way an investor makes decisions. All investors in the United States that are not speculators, all investors anywhere in the world say, my return must be inflation adjusted positive. Because if it's inflation adjusted negative, I'm losing net worth. And 99.99% of all investors that are putting money into money market today are inflation adjusted net worth. None of those people are actually investors. They're all speculators. Speculators put money in when everyone is putting money in. These are the people that 24 months ago, 18 months ago, put money into 3-cap properties. And now, of course, those properties are not doing well. Many of them are doing cash calls. And all these kinds of things are happening in the marketplace. And they're feeling bad about what they did back then. And so now they're not ready to invest. And I want to say to all of these people, if you're not a speculator, why wouldn't you invest today?
Yeah.
Prices, and multifamily is a good example. There's many other examples. Minnie gave you those.
Yeah.
Multifamily today is on average 22% cheaper than it was for the same net operating income. This is important. For the same NOI, multifamily is 20 to 22% cheaper. Where people before were underwriting 4% rent growth, today they're underwriting 2%. Where people before were underwriting an exit of 4.5 cap, now they're underwriting an exit of 5 cap. So everyone is more rational. Everyone is today in a better position. Why are investors not investing? Well, that's because they're not investors. They're speculators. Speculators follow the horde. They can't do contrarian thinking. They love to think that they're contrarian. They love to say the famous Warren Buffett quote, which is, when everyone's greedy, be fearful. When everyone's fearful, be greedy. Right now, everyone's fearful. This is a time to be greedy. So, unlike Vinny, I don't think that multifamily is going to be red ocean for long. I think it's been red ocean for the last 18 months. I think it's still red ocean. I think by Q3 or Q4, you're going to see this crosscut. I call it the crosscut. The crosscut is when you have cap rates still rising and interest rates beginning to drop.
Drop down.
So
Yeah.
that point at which there's a cut between these two is the point where you want to buy every asset that you possibly can. And bridge lending will return for multifamily in Q1 of next year, because most people think that bridge lending will not come back until interest rates are low. Well, that's because you don't study finance. Bridge lending has nothing to do with high interest rates. You can have robust bridge lending even if you have 10% interest rates, 20%, 30%. Bridge lending goes away when people are not sure about the direction of rates. Direction, upward, downward. That's what affects bridge lending. In an environment where rates are going to be either flat or going downwards, you can get bridge loans, right? Because lenders are feeling good about that environment. In the same exact way, as I said, bridge loans will come back in Q1 next year. Cheap rate caps will come back in Q1 next year. Once again, most people are like, as long as interest rates are high, rate caps are going to be expensive. That's complete and utter nonsense. Study finance. Rate cap pricing has nothing to do with interest rates. It has to do with direction of interest rates. When interest rates are going up, rate caps are expensive. When interest rates are going down, even if they're going down slowly, rate caps are cheap. So anyone that thinks that rate caps are still going to cost $1 million or $2 million 12 months from now doesn't understand basic finance and doesn't understand how the sellers of rate cap are actually pricing them. Their fear is not that interest rates will stay high. Their fear is they will go higher. So the moment the Federal Reserve cuts interest rates one time, just quarter point, one time, probably will happen in February or March. At that point, rate cap costs collapse because now rates are going downwards and anyone selling a rate cap is in the money instead of now where they're out of the money. They've been paying up for these 2 years, right? They've been paying out to you because you had a rate cap. They're paying out Ruben. They're paying out Andy. They're paying out Vinny. Everyone's getting money from the rate cap people. Yeah. But the moment the rates start to go in the downward direction, you're paying them and they're not paying anything back. You see what I mean? So here's what is likely to happen. And this is going back to your question, Andy, right? I'm trying to answer the question in a full way. I don't expect cap rates for multifamily to decompress anytime in the next 9 months, maybe 12 months, but not in the next 9 months, because cap rates are a trailing indicator of the cycle. Basically, what that means is cap rates are just late, okay? Rate caps and bridge loans are leading indicators. They adjust quickly. So I expect that bridge lending will make its return in Q1 or Q2 of next year. Cheap rate caps will make their return in Q1 or Q2 of next year. But you will still see at that point of time, here's the cool stuff. This is very important. Write it down if you want to. You will still see higher cap rates in Q1 and Q2 than you do now, because cap rates are trailing indicators and they will continue to go upwards, meaning cheaper properties, while rate caps are getting cheaper and bridge lending is getting cheaper. So you have a window of opportunity, I call it Q1, Q2, and Q3, where you've got on the lending side, things are all of a sudden looking better. On the rate cap side, things are looking better, but you're still getting properties that are cheaper than a quarter or two before because of the trailing nature of cap rates. Now by Q4 of this year, maybe Q1 of next year, you now might start to see cap rates compress again and prices start to go up. But I don't expect that to happen in the next year. What is going to make it harder for prices to stabilize and cap rates to stabilize is two things. Number one, 2,500 distressed multifamily properties, of which half have to be sold next year in 2024, and then half have to be sold the following year. So there's a lot of supply. Second, new construction supply. We have 425 units 425,000 units delivering this year, nearly 400,000 delivering next year. That's going to keep a pressure on rents. Pressure on rents means pressure on prices, right? So bottom line is, multifamily is a red ocean. Vinny Chopra said it. I agree with him. The ocean is going to turn blue or purple in Q1 and Q3 and start to turn blue in Q3 and Q4 of next year. So prepare for that and tell your investors about it.
And by the way, that 2,500 units, we're talking about out of what, 100, 105, 110,000 units, right? So we're talking about that's this kind of compressed inventory that if you can be buying now, fantastic. It's not, we're not in a situation as everybody thinks that if those 2,500 units, and we say that's maybe a little more, maybe a little less, that is doom and gloom. We're talking about this compressed amount of properties, right, that are exposed. And that's
exactly. So there are 19.7 million units in CoStar. Let's assume that those 19.7 million units, all of those properties are 200 units, just to make the math easy, right? That means you have 101,000 multifamily properties. Of them, about 3,000 are at risk, and that's 3%. That's what people don't get, because no one in the industry can answer my question when I say, how many multifamily properties are in the United States over 150 units? Nobody knows, right? But what I do know, and by the way, I don't know the answer to that question because I've never seen it published, but I know that there's 19.7 million apartment units. Why? Because Yardi Matrix uses that number and so does CoStar, right? So they're both looking, and I don't think they're counting super small properties because they never look at them, right? So of the institutional grade stuff that we buy, 50 units and above, those properties, there's about 20 million units. Assuming they're all 200 units, there's 100,000 properties, and there's 3,000 properties in trouble. So you have to understand that this trouble doesn't mean contagion. Trouble doesn't mean the kind of crash that we saw in 2008. Trouble means downward pressure on prices and nervousness from lenders. And we're dealing with both of those right now.
Awesome. Ruben, I think we probably have some questions, but
I have a follow-up question for Neal. I mean, this is like such an informative session for me. And I really love your insight, Neal, always whenever I listen to you. Even I watch your videos too every now and then. So you've been talking about this BTR community, and then I love your data, you're data oriented. And then you did all the calculations and you came up with this income group, 60 to 75K. You say, these are the people who are basically renting or the tenants for the BTR community. So, but this BTR community, and I think a lot of people fall into this category, 60 to 75K, maybe majority of it in today's date, I would assume, because a lot of families both partners are working. And my question to you is, with this asset class, rapidly gaining the traction or the popularity, how is gonna impact the multifamily apartment buildings? With the value add, because here you're getting a new facility to live and more room in the front and the back with the families versus the apartment buildings.
I don't see any impact at all on Class B and Class C properties. Remember that there's 350 units of new construction. Almost all of that is Class A, Vinky, right? And almost nobody builds Class B buildings anymore. Everyone builds Class A. So out of those 350,000 per year, about 50,000 are going to be BTR. So now we're reducing, and some of those same builders that were building apartments are the builders that are now building BTR. So they're just switching over. So what's happening is, and some builders are building both apartments and BTR, right? So hopefully if the market doesn't get oversaturated, what's happening is BTR is taking a 50,000 unit every year chunk out of the Class A marketplace. And because BTR rents are at the same price as Class A apartments or a little bit higher, usually $100 higher, it only competes with the Class A market. Why would there be a Class B or Class C competition? Now you might say, well, what happens when these units get older? Well, the short answer is a 20-year-old townhome community is no different from the townhome communities that you and I are already buying in value add. We're already buying them. The property that I'm buying this Thursday, right, 2 days from now, is Park Avenue Villas. It's a 1984 built townhome. I don't call it BTR because nobody else does, right? It's just an apartment complex that has townhomes. We know this, right? I mean, anybody that has sold a townhome community from 30 years ago, you never put BTR in your offering memorandum because people would laugh at you, right? So at some point, Vinky, BTR just is apartments with townhomes, but not when they're new. When they're new, they're on their own asset class, right? When they get older, 20 years from now, they'll just basically become a Class B apartment complex with townhomes. So the impact to multifamily value add is fairly minimal. The impact to Class A apartment construction is significant because that 50,000 unit per year chunk is coming out of existing apartment construction. But I don't think it's a big deal because it's the same builders that are saying, I used to build 4 apartment complexes a year. Now I'm going to build 3 apartment complexes and 1 BTR. That's what's really happening. The same people, the same builders are just building BTR now as part of their overall portfolio.
I think we got
It's not a
time
replacement for apartments.
I think we got time for one more question.
Yep. Yeah, I definitely have to jump off in a few minutes.
Thanks, Neal. And then just a follow-up question was, from the investor perspective, what would they prefer, investing in a BTR or the multifamily? Because everybody's talking about all the years, multifamily. So people are kind of tuned to invest in multifamily. All of a sudden, this new asset class pops up, BTR. So you were talking about early convincing the investors too, like talking about the Warren Buffett's famous quote as well. Like people are already scared, and that's with new asset class popping up. How do you convince your investors to invest into BTR compared to multifamily?
The BTR is multifamily. You must convince people of that. You have 100 or 150 townhomes. Everyone's a renter. All of them are in one places. Which part of this is not multifamily? It's just townhome multifamily. Vinky, it is multifamily. Okay, you go to CoStar, click on multifamily. So CoStar has, hotel, self-storage, multifamily. Click on multifamily, go to any state in the US and sort, you'll see the BTR properties right there.
Mhm.
There isn't a separate drop down in CoStar that says multifamily and then below that BTR. Nothing like that exists. Right?
Good.
Built to
Yeah.
rent is multifamily.
Just a fancy name, horizontal multifamily, I guess.
Horizontal multifamily or built to rent, built to rent essentially is, look, we're giving them a home-like look, but in the end, they're renting. It's an apartment complex.
That's true.
Nice work. Thank you.
Thanks.
All right, we're gonna cut out here. Neal, dude, it's always so good to see you, man. I know that we didn't get a chance to go into, like the times that you were stuck in the principal's office as a kid. Next time we'll touch on that. But man, I really appreciate you coming on, man. This has been a blast, and I look forward to sending this out to my audience on the Capital Raiser show. So thanks.
I
thanks
think
much,
there
man.
should be a study, Neil. Maybe that's one of the, you can put your data room, because I know you have this huge data room. What's the percentage of entrepreneurs in general that had a higher rate of being in the principal's office? I bet you it's pretty high for entrepreneurs and real estate.
I wouldn't be surprised at all. I wouldn't be surprised. I think that entrepreneurs are norm breakers by default. And the problem with school is there's too many norms. So I really actually enjoyed my time in the principal office because the principal liked me. And you didn't really sit in the principal's office. You sat in that area right outside where the assistant sat, and you'd go there and you sit and you sort of grin at the assistants, and the principal would wink at you as he went by, right? Yeah, I spent a lot of time on that bench. And Vinky's like nodding because she's like, yeah, I know the Indian schools are like that.
Great stuff, man. Thank you, everybody.
Thanks.
Take us out, Andy.
Yes, well, thank you all for joining us. It's always fantastic to hear wisdom from our mad scientist. And thanks, Vinny, for coming in and adding your more than 2 cents, right? You've always got something great to say, but always a pleasure being with you, brother Ruben. Thank you for having us on your show.
Rock and roll. Peace and strength, my friends.
Legacy Acquisitions